Silver hit 121.88 per ounce on January 29th, 2026, then lost nearly 40% of its value in a matter of days. Today, February 18th, 2026, it is sitting at 73.70 and quietly moving higher right before the most important Fed document of the year drops tonight. If you are holding silver and you do not understand what is happening right now, the next 48 hours could either protect your wealth or destroy it. Welcome to the Market Flux. If you are new here, I break down what is actually happening in markets while the mainstream media keeps you distracted. Subscribe right now, because what I'm about to show you about silver, the Federal Reserve, and what the institutions are actually doing behind the scenes could completely change how you see this metal. Let's start with the exact facts. No opinions, just numbers. On January 29th, 2026, silver reached an all-time record high of $121.88 per ounce. On the COMEX, that is not a typo. In 2025 alone, silver gained over 140%. The metal crossed $100 for the first time in history. Industrial demand from solar panels, electric vehicles, and AI data centers was consuming the metal faster than mines could produce it. Then, without warning, the single largest single-day crash in silver's modern trading history hit. In one session, silver dropped 35%, a 22 sigma event. That means it was statistically so extreme it should not happen once in billions of years of trading. By February 4th, silver had partially recovered to $92. By February 12th, it had slipped back again. Today, February 18th, it is trading at 73.70 and is down 3.50% on the day alone. Here's the thing. This is happening the same day the Federal Reserve releases the FOMC meeting minutes from its January 28th and 29th session. Those minutes drop tonight, and silver is sitting at a critical price point waiting for what those minutes say. To understand why that matters, you need to understand a mechanism almost nobody in mainstream financial media explains clearly. Think of silver like a balloon tied to the floor with a string. The Fed's interest rate is that string. When rates are high, the string is tight. Capital flows into bonds, savings accounts, yield-bearing assets. Silver just sits there. It pays you nothing. But the moment the market believes the Fed is about to cut, even before a single cut actually happens, the string goes slack, the balloon starts to rise. Right now, that balloon just had the string yanked back tight. But not because the economy is strong. Kevin Warsh was nominated to become the next Federal Reserve Chair. Markets labeled it the Warsh shock. Warsh is perceived as significantly more hawkish than Jerome Powell. That one nomination immediately strengthened the US dollar index toward 97.50. A stronger dollar crushed silver's upward momentum almost instantly. But here is what the mainstream media is not telling you. The FOMC minutes being released today are not Warsh's minutes. They are Powell's minutes. These are the internal conversations from January 28 and 29, before the Warsh nomination changed the market's entire rate expectation framework. If those minutes reveal a more dovish Fed than markets currently believe, silver moves up sharply today, this afternoon. But the mechanism that caused the January crash in the first place has still not been fully explained to retail investors. The CME Group raised silver futures margin requirements 7 consecutive times in the weeks surrounding the all-time high. The final margin rate hit 18%. That means for every contract you held, you had to have 18 cents of actual capital for every dollar of exposure. When margins go from 5% to 18% in rapid succession, leveraged traders do not have a choice. They sell immediately, not because they want to, because they have to. It was not fundamental sellers who crashed silver from $121 to $73. It was forced liquidation. Think of it like a casino that suddenly triples the minimum bet at the table. Players who cannot afford the new minimum are pushed out of their seats, even if they believe the next card is an ace. That is exactly what happened. The game got expensive. Speculators, particularly Chinese traders who had built enormous leverage long positions, got forced out. U.S. Treasury Secretary Scott Bessent publicly said exactly this. He attributed the January crash to speculative Chinese positions being forced to close, not to a change in silver's industrial story, not to a change in supply, not to a change in demand. A forced margin call liquidation, that is the mechanism. And when forced liquidations drive a price crash, what typically follows is accumulation by the buyers who actually understand the asset. Now let's talk about 3 specific reasons why silver is rising again right now, ahead of the Fed minutes. Reason number 1, the January CPI data confirmed inflation is cooling. U.S. headline inflation dropped to 2.4% year over year in January 2026, down from 2.7% in December. Core CPI came in at 2.5%. Cooling inflation theoretically gives the Fed room to cut rates, and silver knows it. Reason number 2, the DXY, the U.S. dollar index, is showing signs of exhaustion. It spiked on the Warsh nomination but has since been drifting. Analysts note that concerns about Federal Reserve independence under a new chairman are actually weakening the dollar, not strengthening it. A weaker dollar is mathematical fuel for silver. They move in opposite directions with near perfect consistency. Reason number 3, the industrial demand case never changed, not for a single day during the entire crash. Solar panel manufacturing is expected to consume over 200 million ounces of silver in 2026 alone. The Silver Institute confirmed silver is now in its 6th consecutive year of structural supply deficit. That means demand has exceeded production for 6 years running. The crash was a paper market event. The physical market kept running at full speed. Now here's the part that should make every retail investor in this space stop and think very carefully. While you were watching silver crash 40% on your screen, reading silver's over posts on social media, feeling fear and confusion, here is what the institutional money was actually doing. JP Morgan analysts published notes calling the January crash inevitable and healthy. Pan American Silver, a major institutional mining play, saw analysts quietly reaffirm long-term price targets above $95. Well, inevitable and healthy is not the language of sellers. It is the language of buyers who want you to sell to them at a discount. Meanwhile, ETF managers continued to accumulate positions in the iShares Silver Trust and equivalent vehicles during the exact same weeks the price was falling. The gold-to-silver ratio, a measure of how many ounces of silver it takes to buy 1 ounce of gold, shot from a 47x low all the way back to near 70x during the crash. Historically, a ratio above 70 has signaled silver is deeply undervalued relative to gold. That ratio is now sitting right at that threshold. While you were distracted by the falling price, they were watching the ratio. While you were reading headlines, they were reading the mechanism. But here is what most people completely miss. There's a historical pattern that has played out before with frightening precision. And when you see it, everything happening right now in silver will suddenly make perfect sense. Let's go back to March 2020. Silver was sitting at $14 per ounce. The Fed had just emergency cut rates to near zero. Most retail investors were terrified. Headlines said the economy was collapsing. Institutions were buying everything they could touch. Over the next 12 months, silver went from $14 to $29, a 107% gain, not because the world was suddenly fine, but because the mechanism shifted. Cheap money, weak dollar, and safe haven demand all arrived at the same moment. Then go back further. September 2010, silver was at $20. The Fed announced a second quantitative easing program, QE2, on November 3rd, 2010. By April 2011, silver had reached $49.82 per ounce, a 149% gain in less than 6 months, triggered almost entirely by the expectation of easy money flooding the system. That is the pattern. Every time the Fed pivots dovish, or even signals it might, silver does not walk higher. It runs. Now here is what has not changed, even after silver crashed 40% from its all-time high. The Silver Institute confirmed the global silver market is in its 6th consecutive year of structural supply deficit in 2026. Demand has exceeded production by 160 to 200 million ounces annually. Mine supply has shrunk by 0.9% every single year since 2020, according to the Shanghai Metals Market. At the same time, demand from solar panels, electric vehicles, and AI semiconductors keeps accelerating. The photovoltaic industry alone is expected to consume 230 million ounces of silver in 2026. Each solar panel uses roughly 20 grams of silver that cannot be recycled or recovered once deployed. The gold to silver ratio is sitting at approximately 70 right now on February 18th, 2026. Historically, a ratio above 70 has almost always resolved in silver's favor. It means silver is deeply undervalued relative to gold, and eventually the ratio always corrects. And the dollar is structurally weak. The DXY lost nearly 10% of its value in 2025. Federal debt concerns, fiscal expansion, and de-dollarization trends out of BRICS nations are not going away. These are the 4 fundamentals that didn't move an inch during the January crash. Supply deficit, industrial demand acceleration, the gold to silver ratio extreme, and dollar weakness. They are all still fully intact. Now, on the record, screenshot this: silver will trade at or above $95 per ounce by August 31, 2026. Here's why. The Fed is being pressured from 2 directions simultaneously. Inflation at 2.4% is close enough to the 2% target to justify cuts. Meanwhile, economic uncertainty driven by trade tariffs, geopolitical tension in Venezuela and the China-Japan corridor, and growing concerns about U.S. fiscal sustainability are all pushing the same direction, toward dovish policy. The market now expects multiple Fed rate cuts through 2026, and lower real rates are historically bullish for precious metals, especially silver, which benefits from both safe haven and growth-sensitive demand. If the FOMC minutes released today confirm even 2 dissenting votes for immediate cuts in January, silver's pressure valve opens again. That is not speculation. That is the mechanism playing out exactly as it has in 2010 and 2020. Now let's talk scenarios with real probabilities. Scenario 1. The Fed minutes today confirm dovish internal tension. Multiple governors pushing for faster cuts. Silver breaks above $80 by end of February and builds toward $100 by June 2026. Probability? 55%. Scenario 2. The minutes are neutral to slightly hawkish, confirming the Warsh effect is already reshaping Fed thinking. Silver consolidates between $68 and $80 for the next 60 days before resuming its uptrend later in Q2 when rate cut expectations firm up again. Probability, 35%. Scenario 3. The minutes signal an unexpectedly unified Fed with no real dissent, and the dollar surges. Silver drops back below $65, retesting the $60 to $65 support zone. Industrial demand absorbs the dip within 6 to 8 weeks. Probability, 10%. Now let's talk about what you should actually do, because the right action depends entirely on where you are right now. If you're holding physical silver, the message is simple. You are holding the asset that has the strongest fundamental case of any metal on the planet right now. The January crash was a paper market event. Physical supply is tighter today than it was before that crash. Hold. Do not let a futures-driven margin call liquidation shake you out of a structural position. If you're actively trading with leverage, stop watching the price and start watching the DXY. The dollar is your leading indicator. When the DXY breaks below 97, silver tends to accelerate upward within 24 to 48 hours. Set your triggers on the dollar, not on silver directly. If you're sitting on the sidelines with cash, understand this. The panic is priced in. Silver at $73 is not silver at the top. It is silver after a 40% forced liquidation crash. If you waited for a correction, this is what a correction looks like. You do not need to buy everything at once. Scale in over the next 3 to 4 weeks. If you bought at the top near $121 and you are underwater, know this. You are not in the wrong trade. You are in the wrong time frame. Silver's deficit is not a quarterly story. It is a multi-year structural story. The question is not whether silver goes back above $100. The question is when. Now here is exactly what to watch going forward. Watch the DXY daily. The dollar index moving below 97 is a green light for silver. Moving above 100 is a warning sign. Watch COMEX silver inventory levels. When inventories drop below 300 million ounces, delivery stress appears. That is where paper price and physical price begin to disconnect violently. Watch the Federal Reserve's preferred inflation gauge, core PCE. The next release is February 28th. If it comes in below 2.6% year over year, it changes the rate cut calculus significantly in silver's favor. Watch the gold to silver ratio. If it breaks below 65, silver is already outperforming gold. If it spikes above 80, institutions are moving into gold as the lead safe haven and silver is lagging. Adjust accordingly. Now I want to talk about the 3 types of people watching this video right now. The first type is panicking. They bought silver somewhere between $80 and $121. They are checking their portfolio every 20 minutes. Every red candle feels like confirmation they made a mistake. They are about to sell right before the mechanism reverses. The second type is frozen. They have been watching silver for months. They want to buy. They have the cash. But every time they decide to move, the price either spikes and they feel late, or it crashes and they feel scared. They are stuck in a cycle of almost. The third type is learning. They watched the crash. They read the data. They understand the margin mechanism. They understand the Fed pressure valve. They are not reacting to the price. They are positioning around the mechanism. This type wins. Not every time, but consistently. Every major wealth transfer in financial history followed the same pattern. Prices move violently in one direction. The uninformed react to the price. The informed react to the mechanism. Wealth flows from the reactive to the prepared. The January crash from $120 to $73 was not the end of silver's story. If anything, it reset the conditions for the next move. Forced liquidations cleared the weak hands. Industrial demand kept running. The Fed pressure valve is tightening toward another release moment. This is exactly what we talked about at the start. Silver rising quietly ahead of a Fed minutes release, while most investors are either panicking or frozen. The mechanism is still intact. The question is, which type of investor you choose to be right now. If this video helped you understand something the mainstream media refuse to explain, hit the like button and share this with someone who is still trying to make sense of what just happened to silver. Subscribe if you want to be the third type, the one who watches the mechanism instead of just the price. And drop one word in the comments right now. Type mechanism if you finally understand why silver crashed and why it is rising again. This video is for informational and educational purposes only. It is not financial advice.